Hello, everybody, and welcome back. Today, my guest is Jonathan Waghorn. Jonathan is a portfolio manager from Guinness Asset Management. And today we want to discuss the latest trends in sustainable energy markets. Welcome, Jonathan.
Thank you very much.
Jonathan, global energy markets have been extremely volatile in recent months. So what is the root of all the problems?
I guess there's always short-term factors and there's long-term factors. And if we think about the short-term factors that have been happening, Thomas, it's an economic recovery driven predominantly by Asia, so strong demand. So that has been a pull on energy resources. At the same time, that coal production in areas like China has been under pressure, partly because of safety issues and partly because of carbon issues. There's been low levels of hydropower generation in China. So China's been short of energy. It's had to import natural gas via liquefied natural gas that it has done at a kind of irrelevant price. Asian gas price is currently $35 per MCF, over $200 per barrel of oil equivalent. So a thirst for energy. That has left the European market short of liquefied natural gas. So again, Europe has had to fight and compete. We've had higher carbon prices, making coal that much more inefficient. We've had low wind generation in the European markets as well. A combination of a number of short-term factors that have all come together to cause this crunch as we go through a winter period that it probably will be sustained through the breadth of the winter period. In addition, then the long-term factors are the big structural issues. Oil prices have been on a downward trend now for 10, 15 years, and investment has followed that as well. So if you think about investment into oil fields, we're down more than 50%. And if we don't invest in hydrocarbons, we don't have the supply to respond. And that will be the long-term structural issue that is compounding some of those shorter-term factors that I just mentioned.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So with the COP26 summit at the latest, it seems clear that the era of fossil fuels is coming to an end now. So how soon will this era end and climate neutrality be achieved?
I guess it's still some time. It's still some time. So if we think about the fossil fuel industry, it satisfies about 84% of world energy demand at the current time. We are not going to get off fossil fuels kind of that quickly. We found the IPCC report in the middle of this year particularly informative. That's the science behind climate change that drives the decisions that are made at COP26 as an example. So if you look at the carbon emission trajectories and the temperature warming associated with those trajectories, it gives you a bit of a sense as to the urgency that is needed here in making this transition. So that's been a very, very useful piece of science. And we at Guinness, we've managed to look at that science and see what are the implications for our kind of global energy model. And myself and my colleague Will, running the two funds in energy at Guinness, we run a 30-year, 50-year forecast energy demand model, understanding the economics of supply and demand, different technologies, how will they interplay? And associated with that then is a carbon emission profile as fossil fuel demand and supply starts to roll over. And using the IPCC science, we believe that our base case is consistent with about 2.3 degrees of warming. Now, our base case assumes a very rapid transition indeed, but it is not sufficient to get to that 1.5 degree target. Now, if you believe the IPCC science, we clearly need to do an awful lot more. So our base case says that neutrality point is after 2050, but everything is moving very quickly here in terms of government policy and pressure and support and investment. So hopefully moving towards the 2050 period, but at the minute, some way behind.
So currently big oil is part of the climate problem. The industry is dependent on its huge profits from oil and gas. So what exactly needs to happen to accelerate the transformation of the oil and gas industry?
Yeah, it's very easy for us to point the finger at big oil, but at the end of the day, it's us as consumers that use the product and we create those emissions. But that's the system that we're in, and it's a very big, very involved system it will take time to change. I think one of the key factors driving that will be a carbon price. We look at European carbon prices now over 70 euros a ton. There is no global carbon price. Article 6 was agreed at COP26. That leads the way towards a global carbon price. But and again, it is still a long, long way away. But a carbon price is both, as we would say here in the UK, a carrot and a stick. It is a carrot to tempt those investing in technologies that consume carbon or supply that is low carbon to go ahead and develop. And then it is a stick to change the behavior of the emitters of carbon and to force that change. Now, I'd make the point that change is already starting to happen. So the energy companies are well aware of the transition that is ahead of them. So at the end of 2019, as an example, there was only one of the top 15 largest oil and gas companies, it was Repsol, that had a net zero emission pledge for 2050. As we get now to current times, we now see 10 of the top 15 having 2050 net zero pledges and targets, including some of the major US oils, but not quite at this point, including ExxonMobil. Now, what will the major oils be doing here in terms of their route and their plan to achieve this? It's growth of low carbon electricity, that's fine. It's also expansion of petrochemicals, so that's the combustion or the use of hydrocarbons without that much in the way of carbon emissions, so it's non-combustion of hydrocarbons. They'll be scaling up biofuels, so hopefully getting growth into areas like airline fuels and sustainable airline fuels. Carbon sequestration, so consuming and storing the carbon that they have, and then also getting into areas like green hydrogen, we would expect. These are the companies that understand the energy industry. We need them. We need their help. We need their knowledge. We need their technology to make these changes just as much as their capital as well.
To what extent will the fiscal stimulus in the US and in Europe fuel energy transition, and who will be the beneficiaries of those programs?
So the post-COVID stimulus that we're seeing, the kind of the build back better and build back kind of cleaner and greener, is being seen across most countries. That's only the start of it, though, to be honest with you. The energy transition is a 20, 30, 40, 50-year story. And it will need more than just some of this kind of post kind of COVID stimulus. But the stimulus that we have at the time, it's attractive because developing and incentivizing green energy projects at the expense of the fossil fuels is, as far as we can see, it increases employment. So these projects are more employment intensive in local areas than the fossil fuel equivalents. There's some economic materiality, so we believe there's a multiplier effect on GDP, and I've read from organizations like IRENA that multiplier effect can be as much as 5 times. And I think also just the low interest rate environment that we're in makes these kind of sustainable energy projects, which are very capital intensive up front, a lower interest rate environment makes them much more economic relative to fossil fuels on a relative basis. So this is an environment that really does lend itself towards turning towards low carbon activities. So it's employment, it's economic materiality, and it's driven very much by the interest rate sensitivity. Now, I look at a universe of about 250 to 300 sustainable energy companies. I won't name them all here, but typically speaking, they are all beneficiaries of what is going on in this current environment.
In which areas of the energy transition will see the big investments, the largest investments in the coming years? And will this come significantly from big oil or in the majority from other investors?
In a way, this is the billion-dollar question, but sadly, it's an awful lot more than $1 billion. I think our best way of explaining and illustrating where the money goes is to look at the plans associated with the European Green Deal. The Green Deal is the most progressive, we believe, of all the climate policies that we see globally. And the Green Deal, on the estimates of Goldman's, is around 10 trillion euros to be spent between now and 2050. Where does that money go? We see about 50% of it going to what we call the demand side. We call it consumption. So that's things like energy efficiency. So that is heat pumps, it's insulation, it's LEDs, so that the heating and efficiency, that covers areas like buildings especially. We then get into things like transportation, and that's about a quarter of total spend. as well. So it's passenger vehicles, passenger electric vehicles, sort of 10 to 15%. Batteries, a similar level of expenditure as well. The networks and the charging stations that are associated. So about half of the money to the demand side, split about half to efficiency and heating, and about half to transportation and the network around electrified transportation. The other half of the expenditure then is on the supply side of the equation, and that's very much dominated by renewable power generation and the networks associated and the upgrading of the transmission grid. So overall, that's just over a third of total capital expenditure. And then the EU Green Deal has a focus on hydrogen. So that takes 5 to 10% of capex. And then associated with that, there's things like decarbonisation as well. So they're some of the key areas. And I can assure you, we pay pretty close attention as to where that money is going, which companies will be the beneficiaries of it. But in terms of this new spend, it's not the existing oil companies, not in a big way. Their expenditure is still heavily focused on the fossil fuels, their equity value very much driven by fossil fuels, and therefore fossil fuel price movements very much driving their share prices.
What realistic role will alternative energies play in the energy mix by 2050? And will we see positive surprises by technology, or will traditional energy sources still be in the lead?
Yeah, so there's a big switch coming, and on a 30-year view, I can virtually guarantee to all the listeners that my forecasts will be wrong. So this is a 30-year plan. I mentioned earlier, 84% of current world energy demand satisfied by hydrocarbons. So that's 16% from low carbon, and obviously a very dramatic growth to come through. Bear in mind, world energy demand has grown by 70% over the last 30 years. So not only do we need to think about the transition, but we need to think about also satisfying the growth as well. So our assumptions are at Guinness that we have improved energy efficiency. World energy demand grows around 1% per annum over the next 30 years. That in and of itself is an enormous assumption. Filling in then what is required, we think about 40% of that comes from renewables. So that includes wind and solar, geothermal and biomass. The implication being that there is still a role for the fossil fuels within the mix. Coal and natural gas today represent about 50% of world energy demand. We think that falls to about 20% by 2050. Predominantly at the expense of coal, but coal still has a little bit of a part to play. Natural gas as a fuel that allows peaker electricity generation is particularly important to sustain. And oil still has a role, even though we expect to see the number of electric vehicles growing dramatically. We think that 50% of all new car sales will be electric vehicles in 2030, and all new car sales will be electric in 2040. There's still oil consuming cars on the road. So there's still a role for oil at time. There is great potential for any new technology to come along and to transform, to impact. Where do we see most excitement, or where do we see a lot of interest at the minute? I think it is on the decarbonisation of the fossil fuels. That's a particularly interesting area. To what extent can we continue to consume fossil fuels, but by dealing with the carbon in an efficient and economic manner, to make sure that countries can rely on good quality power and energy to fuel their economies without having to deal too much with the intermittency of the renewables.
Especially hydrogen stocks have been hyped during the last couple of months. And how far away are we from a relevant share of green hydrogen in the energy mix? And what exposure do you have in this sector of your portfolio and your mutual fund?
Sure. So we're a long way away from green hydrogen playing a big component in the world energy mix. I mean, it is de minimis at the current time. In our opinion, hydrogen has a part to play. I mentioned the EU Green Deal. It's because we will be growing renewable power generation. We will be producing power from wind and solar because they are at the bottom end of the cost curve. That's where the focus is. By definition, that means we will be generating power at times when it is not needed. So what do we do with that power? Well, lithium-ion batteries, various things, but the hydrogen economy is a sensible solution So we use that excess electricity, we put it through electrolyzers, and we create hydrogen. The hydrogen then can be used in various ways. So it could decarbonize a natural gas stream. It could go into a fuel cell to create electricity for transportation, as an example. So it has its uses. The problem is that green hydrogen is wildly uneconomic. It's 6 times the cost of grey hydrogen. So it requires an enormous amount of subsidy to get this working and to get it happening. So the growth story, fantastic, very, very exciting indeed. And your word hyped is exactly what we have seen in and around hydrogen. Let me tell you, from my point of view, I'm trying to find good quality companies that have growth opportunities that deliver for our investors, we hope, the best returns we can get our hands on. I'm not trying to pick the stories. I'm trying to pick some good companies that will benefit from the transition. So the universe that we put together, we find 12 companies in our universe of nearly 300 that are hydrogen companies. There's $53 billion of market capitalization in those 12 companies, and around 50% of that comes from just the one company. So there's a number of very small, kind of nascent new idea companies there. Our universe has a market cap of $5.6 trillion. So you'll get a scale of it. So by number, it's 4% of the universe. By market cap, it is 1% of our universe. And within our fund, we have less than 1% of our assets under management exposed to hydrogen. We do not have any pure plays. We have some through one of our existing holdings. So that there is an illustration of our inability or the problems that we have found in trying to find good quality play on the hydrogen story that we feel we can rely upon. We'll keep looking, don't get me wrong.
So this was Jonathan Waghorn from Guinness Asset Management. Thank you very much, Jonathan, for being with us here today and sharing your insights.
It's been my pleasure. Thank you all very much for listening.